In 2008, millions of Americans lost their homes. Streets once filled with families became rows of foreclosures. For sale signs stood like gravestones of broken dreams, and Wall Street trembled as the economy collapsed under the weight of bad loans. Everyone swore we'd learned our lesson, that such a disaster could never happen again. But what if it's already happening quietly? Right now, only this time, it isn't mortgages pushing America toward collapse. It's credit cards. The same formula that detonated the subprime housing bubble, easy money, reckless lending, and blind optimism has crept back into our wallets, disguised as convenience and financial freedom. The addiction is everywhere. Tap, swipe, spend, repeat. And for most Americans, it feels like survival, not luxury. Today, the average American carries over $7,000 in credit card debt, with interest rates soaring above 20%, the highest in decades. Every purchase, every emergency expense, every just this once swipe adds to a growing mountain of personal debt that millions can no longer climb. It is not just a financial statistic, it is a silent crisis that stretches across every age and income level. Young adults juggling student loans, middle-class families crushed by living costs, retirees relying on plastic just to keep the lights on. And while people fall deeper into debt, banks are quietly profiting more than ever. The numbers look disturbingly familiar. In the early 2000s, banks made billions from risky mortgages they knew many borrowers couldn't repay. Today, they're making billions again, this time from credit card interest. Back then, the bubble was tied to homes. Now, it's tied to human desperation. Lenders are not just offering credit, they're engineering dependence. They market reward points and cashback offers. But behind the glossy slogans lies a system designed to trap consumers in an endless loop of payments, minimum dues, and late fees. Just like the subprime borrowers of 2008, millions are being pushed toward default, but few even realize it yet. Inflation has forced Americans to borrow for essentials like groceries, fuel, and healthcare. Wages haven't kept up, prices keep rising, and savings have all but disappeared. Debt has become the new income. Credit cards are no longer tools of convenience. They're lifelines. But every lifeline has a breaking point. And when too many people can't pay their bills, the cracks spread far beyond individual households. The eerie part? Wall Street is packaging this consumer debt, selling it to investors as safe financial products, just like it did with mortgages before the 2008 crash. It's the same game, only the players have changed. The new subprime crisis isn't a T about housing, it's S about humanity. S need to keep up in an economy that punishes anyone who slows down. The stage is set for a financial reckoning that could hit every American home, not through collapsing property values, but through collapsing personal finances. The only question left is, how much longer before the system breaks again, and who will pay the price this time? Chapter 1. The Birth of America's Debt Culture. To understand how America ended up buried under a mountain of plastic debt, we need to rewind to the late 20th century, when credit cards transformed from a luxury to a lifestyle. In the 1950s, a shiny piece of plastic called the Diners Club card was born, meant for businessmen and travelers. Only the elite carried it. But by the 1980s, banks discovered something far more profitable than exclusivity: mass addiction. Deregulation opened the floodgates, and suddenly, credit wasn't for emergencies, it was for everything. Advertising campaigns flooded TV screens promising freedom, flexibility, and the life you deserve. Americans were told they didn't have to wait for success. They could swipe their way to it. Credit card companies marketed debt like a dream. Instead of warning about interest, they emphasized the thrill of spending. Buy now, pay later became the mantra of an entire generation. At first it worked. Consumers spent more, businesses grew faster, and Wall Street celebrated. But underneath the prosperity was a growing dependency. The psychology of credit is powerful. It disconnects desire from consequence. When you pay with cash, you feel the loss instantly. When you pay with a card, that pain is delayed. And that delay fuels overspending. By the early 1990s, Americans were using credit to live beyond their means. The government encouraged it too. A debt-driven economy looked great on paper. More spending meant higher GDP, more jobs, more tax revenue. Banks began targeting the middle and lower classes, flooding mailboxes with pre-approved cards and easy limits. For the first time, millions of Americans who couldn't afford luxury lifestyles were given the illusion that they could. The culture shifted. Saving became outdated. Borrowing became normal. The system rewarded consumption and punished patience. America was no longer a nation of savers. It was a nation of spenders. Every purchase felt justified. Every debt felt manageable. After all, as long as you could make the minimum payment, everything was fine. Right? But that's how every addiction starts. It feels harmless at first. Then it becomes a habit. And eventually, it consumes you. By the time the millennium arrived, Americans were hooked, not just on credit cards, but on the illusion that endless debt could fuel endless growth. No one realized it yet, but the foundation of the next financial crisis was already being laid, one purchase at a time. Chapter 2. The Modern Explosion, Record Debt and High Interest. Fast forward to the 2020s. Credit cards are no longer symbols of convenience. They're survival tools. Americans aren't using them for luxuries anymore. They're using them to pay for groceries, rent, and health care. The numbers are staggering. Credit card debt has now crossed $1.3 trillion, the highest in U.S. history. And interest rates over 21% on average, the highest in nearly 3 decades. For millions of households, that means drowning. The average family paying only the minimum on their balance might take decades to pay it off. Each month, interest compounds, and what began as a temporary fix turns into a lifelong burden. It's not financial management anymore. It's survival math. Why is this happening? Inflation has outpaced wages for years. Rent prices have skyrocketed. Healthcare costs remain unbearable. And yet, the expectation to maintain a normal lifestyle hasn't changed. When people can't earn enough to live, they borrow. And banks know it. Lenders have built an empire out of financial despair. They offer balance transfers, reward points, and credit limit increases, all dressed up as benefits. But behind the curtain, it's a trap. The higher the limit, the deeper the dependency. When someone's card maxes out, banks don't worry. They profit. Late fees, interest payments, and penalties become steady revenue streams. In fact, major credit card companies have reported record earnings, even as more Americans fall behind on payments. The irony is hard to miss. The same economy that claims to reward hard work now profits from financial struggle. And technology has made it even easier. With one tap on your phone, you can make a purchase without thinking. That instant convenience fuels a silent addiction. Invisible, but devastating. Today's consumers are spending more but owning less. Their paychecks vanish before the month ends, swallowed by bills and interest. And as defaults rise, warning lights are flashing. The Federal Reserve has already noted delinquency rates climbing at the fastest pace since 2008. The red flags are there. Again, it's a perfect storm. Rising costs, stagnant wages, and easy credit. Just like the subprime mortgages before the last crash, the cracks in the system are growing wider. The difference is that this time there's no house to repossess, only broken finances and broken faith in the system. Chapter 3. The Parallels to 2008. Subprime 2.0. The story feels hauntingly familiar. Before 2008, banks handed out mortgages to almost anyone. Low income? No problem. No job verification? Still approved. Those risky loans, called subprime mortgages, were bundled together and sold to investors as safe securities. When homeowners couldn't pay, the system collapsed. Now the same strategy is quietly re-emerging, only under a different name: Credit Card Asset-Backed Securities, ABS. In simple terms, banks are once again packaging debt, this time credit card balances, and selling them to investors who believe the risk is low. They've turned consumer desperation into a financial product. But what happens when consumers start defaulting? The investors lose confidence, the value of those securities drops, and the banks holding them face losses. It's the same domino effect that crashed the housing market, except this time, there are no houses, just people unable to pay for daily life. The parallels go deeper. In 2008, credit agencies gave AAA ratings to junk mortgages. Today, they're doing the same with consumer debt packages. Wall Street has learned nothing, or perhaps it's learned how to hide the danger better. Behind every statistic is a real person, a family juggling 5 credit cards to stay afloat, a young professional paying more in interest than rent, a retiree using plastic to buy medication. Millions of these small personal struggles add up to one national crisis. And yet, financial institutions celebrate growth in consumer lending as a sign of economic strength. But when growth is built on debt, it's not strength, it's a ticking time bomb. As delinquencies rise, investors will panic just like they did in 2008. The system will contract credit, banks will tighten lending, and consumers, already overextended, will have nowhere left to turn. In the housing crisis, people lost their homes. In the credit card crisis, they'll lose something less visible but equally devastating: their stability, their confidence, their future. And once again, the people who saw it coming will say, "We should have learned from history." But the truth is, we never do. Chapter 4. The economic domino effect. Debt doesn't just affect individuals, it shapes entire economies. In the US, consumer spending drives 70% of GDP. That means the health of the entire economy depends on Americans continuing to spend. But here's the contradiction. When people are maxed out, they can't keep spending forever. As credit card payments rise, disposable income falls. When disposable income falls, people cut back. Fewer restaurant visits, canceled vacations, postponed car purchases. Businesses then earn less, leading to layoffs. Layoffs lead to even less spending, and the spiral deepens. That's how recessions begin. Not with a bang, but with a gradual tightening of wallets. The same chain reaction unfolded during the Great Depression and again in 2008. History shows that debt-driven economies collapse when consumers can no longer borrow to maintain demand. And right now, we're repeating that cycle. Regional banks and lenders heavily exposed to consumer credit are especially vulnerable. If defaults rise sharply, smaller institutions could face liquidity crises, just like in the early days of the subprime meltdown. Investors, sensing risk, might pull out funds, triggering panic across the system. Even government intervention has limits. The Fed can lower rates or inject liquidity, but it can't force people to spend money they don't have. The psychological impact of debt is powerful. When people feel trapped, they retreat. This time, the domino effect could stretch far beyond finance. With automation reducing jobs, student debt still unresolved, and the cost of living at record highs, the American middle class is weaker than ever. A collapse in consumer confidence could ignite something larger, a cultural reckoning about the cost of living on credit. When debt becomes the lifeblood of an economy, every heartbeat depends on borrowed time. And when that time runs out, the system stops. Not because of external shocks, but because ordinary people simply can't pay anymore. That's the silent crash waiting to happen. Chapter 5. The breaking point. What comes next? Every crisis has a breaking point. For the credit card bubble, that point is approaching. Default rates are climbing. Lenders are tightening their standards. Consumers are juggling debt with side hustles, selling belongings, even taking out new loans to pay off old ones. The illusion of control is fading. Experts predict that if delinquencies continue to rise at the current pace, the financial system could face a chain reaction similar to 2008, though slower, more personal, and harder to detect. The difference is visibility. Housing bubbles collapse dramatically, but credit card bubbles collapse silently inside millions of households at once. Fintech platforms and buy now, pay later services have only accelerated the problem. They've made borrowing frictionless, especially for younger generations. Gen Z now carries record levels of debt before age 30, not from homes or cars, but from daily expenses. These microloans spread risk across millions of individuals, making the system appear stable even as it weakens from within. If the trend continues, policymakers will have to intervene. Some expect new consumer bailout programs or even digital currency systems designed to manage personal debt more directly. But these are band-aids on a deeper wound, a culture built on spending borrowed money to maintain appearances of prosperity. The most dangerous part is normalization. Debt has become so integrated into American life that living paycheck to paycheck no longer feels alarming. People assume it's normal. But normal doesn't mean safe. It means accepted. And the moment society accepts crisis as routine, collapse becomes inevitable. History doesn't repeat. It evolves. In 2008, Wall Street nearly destroyed the economy with subprime mortgages. In 2025, it might happen again, only this time. The battlefield is your bank statement. The warning signs are here. Rising defaults, inflated interest, and a population drowning in plastic promises. The final question is not if it will break, but when. And when it does, the next great financial crisis won't start with a housing bubble. It will start with something much smaller, much quieter, and far more personal. A single swipe of a credit card. In 2008, the collapse was loud. We watched the markets crumble, banks fail, and homes vanish overnight. The fear was visible. You could see it on people's faces, hear it in the headlines, and feel it in the silence that followed. But this new crisis, it's quieter. It doesn't crash all at once. It seeps slowly into everyday life. It looks like the stress of choosing which bill to pay first, the guilt of saying, maybe next month, and the anxiety of checking your credit score after every swipe. It's a crisis unfolding inside millions of homes, one transaction at a time. This isn't just an economic story, it's a human one. Because behind every dollar of debt is a person who once believed they were doing the right thing. Trying to build credit, provide for family, chase a dream, or simply survive another month. America's addiction to credit cards didn't start with greed. It started with necessity. But when necessity becomes dependency, and dependency becomes a business model, the outcome is inevitable. Every bubble in history has been built on the same illusion, that tomorrow will always be better, that the bill can always be paid later. But tomorrow always arrives. And when it does, the reality hits hard. The truth is, this isn't just about credit cards. It's about a system that thrives on keeping people in perpetual debt, feeding on their hope and fear. We've traded financial freedom for financial survival. We've mistaken spending for success and borrowing for progress. The same banks that promise opportunity are profiting from despair, and history is watching us make the same mistake again, just with a different kind of loan. Yet every collapse carries a lesson. When the subprime bubble burst, it forced a generation to question home ownership, lending, and trust in Wall Street. Maybe this time it will force us to question the culture of debt itself, to finally understand that wealth built on borrowing isn't a wealth at all, it's illusion. Perhaps this crisis will remind us that financial freedom doesn't come from access to credit, but from control over our choices. Because history doesn't just repeat, it warns. And right now, it's warning us again. The numbers are rising, the cracks are spreading, and the pressure is building. The only question is whether America will hear the alarm this time, or hit snooze and swipe again. And as always, those who forget 2008 will live it again. Only this time, the collapse won't take your home. It'll take your future.